Support for Radio Friends comes from Le Brunnery Financial, where they work to ensure a lifetime of financial security for people from all walks of life, from investment services to retirement plans. If you're looking for a trustworthy company that has the experience and knowledge to put your interests first, contact Le Brunnery Financial, a community-based investment counseling firm since 1966. Learn more at lebrunnery.com or by calling 573-449-5313. Good morning and welcome to Radio Friends on Monday, January the 13th. We're going to talk a little bit about money today. In the Foolish Corner, we've got John Howe with us. Good to have you here, John.
Well, great to be back. Thank you.
That's your book, The Foolish Corner. And today you wanted to deal with, I hope I can pronounce this correctly, extrapolative expectations.
Well,
right?
Well spoken.
Okay,
well spoken.
What are extrapolative expectations?
Well, let me just start about how I came to this idea. You know, we're kind of at the end of a decade or the beginning of a new decade. Yeah. And so kind of reflecting back, here we are in mid-January, reflecting back on the last decade. So it's been almost a decade since the financial crisis. And so if you look at the stock market over the last decade, it has performed amazingly well. Ballpark, depending on which index you're using, stocks have averaged about 19% per year over the last 10 years. And that is arguably the best decade on record for the U.S. stock market.
And many people are expecting that to continue for the next 10 to 20 to 30 years.
Extrapolative comes from the word extrapolation, so you're exactly right. You hit the nail on the head there.
But what are you saying?
Well, what I'm saying is, first of all, things, so we extrapolate like that. We continue to expect these really good times, but it's highly unlikely they're going to continue for any great length of time. There's going to be some pullback in the market sometime.
Okay, isn't that what's considered a normal adjustment in the stock market?
Absolutely. I mean, there's the stock market goes up and down. And as you have commented in the past, in the long run, the market goes up, but the long run can sometimes be pretty long, 5, 10, 15 years. And so if you think about the next 2 or 3 years, I think a lot of people are thinking, we're going to continue to get this 19% average. I will tell you, in 2019, the market was up 31%. And so I think a lot of people are expecting this really what we call a bull market, when the market's going up and up, to continue. And I think people are getting complacent in thinking about their investments.
Okay, so what do you say then? You don't want to stop saving, you don't want to stop investing.
No, no, certainly not. You want to keep saving always. And I think the main thing is to think about how your investments are split between stocks and less risky investments. And because stocks have gone up so much, they are now a much larger portion of people's portfolios than they were 10 years ago. And so one quite rational thing to do might be to sell some of the stocks and get back into a little bit less risky things, so that when I think this somewhat inevitable pullback happens, you'll be harmed a little bit less.
Okay, and that's what we're dealing with extrapolative expectations.
So I'm saying that people are kind of extrapolating from the last 10 years. They're probably thinking, unless they give it some very keen thought, that times are just going to continue indefinitely as they have been.
But these are very personal decisions that people have to make on their own.
That is true.
Yeah.
A good financial advisor can help.
Okay.
One of the thought experiments, and I think one of the things that spurred my thinking also, is if you go back to the financial crisis, the stock market essentially went down 50%. And I think a lot of people that lived through that have kind of forgotten that, and the really good performance.
The stock market went down 50%?
Yeah. Yep. And from the top, before the financial crisis, to the bottom, it was about 50%.
And how many years ago was this now?
Well, it's kind of started in late 2008 and went into 2009.
So it was over about a year period.
Yeah.
It lost 50%.
Yeah. And so first of all, there are some people that remember this very vividly. If you were planning to retire in 2009 or 2010 and had a substantial investment in stocks, maybe you didn't retire then. I mean, you really remember that. But my point is, there are a lot of people that have kind of forgotten that, or younger people who maybe their investment experience is only over the last 10 years, and they kind of think 19% a year is normal.
Right. But what we have to all remember, too, is we did get through it, and we will get through the next one.
And again, it comes back to the long run because
Right.
stocks do go up in the long run.
You just have to be patient with it and not check every day.
Oh, please don't check every day.
Right,
Please,
right.
no, just look at it maybe quarterly or something like that. And there are reasons for that, which are actually spelled out in my book. But there are reasons for looking at it not frequently, shall I say.
What else is in the foolish corner?
Well, there's a thing called a self-attribution bias that fits, I think, naturally with the conversation we're having. And that is, if you started investing 10 years ago and you've averaged 19% a year, it's tempting to think like, I'm a stock picking genius.
Wow, you say, my goodness, I can't lose no matter what I touch. I've got the Midas touch.
I've got the Midas touch. This is called self-attribution bias, meaning you attribute this success to yourself, when in fact the rising market kind of lifts all boats in a sense. That the performance over the last 10 years maybe doesn't have much to do with your particular genius at picking stocks or something like that. There's a Wall Street phrase that says, never confuse a bull market that is a rising market with brains. Never confuse a bull market with brains,
I like that. I like that.
But I mean, you do have to have enough brains, and this is something we've discussed in the past, to at least own the stocks so that you can participate in that race.
So there's a lot of good information in the foolish corner.
I believe that is the case, yes.
The foolish corner was written how many years ago?
It's been about 3 years almost now.
Yeah. And what kind of comments have you had? Now, you're teaching at the university. What kind of comments do you get from that book?
Well, most people say it's pretty readable. They do pick up on the somewhat subtle or dry sense of humor that's kind of built in there a little bit. But I'd like to believe it's a pretty readable book. It's what we call a trade book. So I'm a professor. This is not an academic tome. This is for a broad audience, and I do think it is fairly readable. That's the kind of feedback I've gotten.
Okay, as a professor, we're almost out of time here, John.
Sure.
But what is the biggest mistake that we make as far as saving for our future?
Well, I think I may expand it from one, but anyway, first of all, not being systematic about it. You can make savings automatic by having stuff taken out of your paycheck, put either into your stock account or a checking account, or better yet, a savings account at a bank. So first of all, be systematic about it. Second of all, for most of us, I think holding a broadly diversified portfolio, a mutual fund or what's called an ETF, people can Google that, with a low expense ratio is an excellent thing.
And starting early.
We've all heard the time value of money, the way things compound over time.
Start early. So if there are people listening or watching us that are in their teens or 20s, it's never too early to start thinking about saving or to start saving.
Absolutely.
Because the 60s and the 70s, that's the age group, it comes a lot faster than you think.
Absolutely. Good advice there, Paul.
Much faster than you think.
Absolutely.
Thank you so much, John Howell.
It is my pleasure.
Author of The Foolish Corner. Please come back again.
Would be happy
All
to
right.
do so.
Tomorrow we got pet health news and the healing chair. Something you'd like to hear or see, I'd love to hear from you. Drop me an email. That's pepperp@missouri.edu. And have yourself a nice Monday afternoon. Bye-bye.